Have you ever wondered how the stock market works or what cryptocurrency really is? These two platforms have become increasingly significant in the financial world, and understanding them is the key to unlocking potential for financial growth and mitigating risks. Let's start with the stock market. Picture it as a grand marketplace where pieces of publicly traded companies known as stocks are bought and sold. It's a virtual arena where investors jostle for profit, betting on the fortunes of these corporations. When you buy a company's stocks, you're essentially buying a piece of that company, making you a part owner. This could mean sharing in their profits through dividends or seeing the value of your stocks rise as the company grows. However, it also means that if the company doesn't do well, the value of your stocks could fall. Thus, the stock market is not just a place for potential financial growth, but also a field where risks are part and parcel of the game. Now, let's turn to cryptocurrency. This is a type of digital or virtual currency that uses cryptography for security. Unlike traditional currencies like the dollar or euro, cryptocurrencies are decentralized, operating on technology called blockchain, which is a distributed ledger enforced by a network of computers. The most well-known cryptocurrency is Bitcoin, but there are now thousands of them, each with their own unique features and uses. Cryptocurrencies can be used for a wide range of transactions, including buying goods, investing, and raising funds for projects. Just like the stock market, investing in cryptocurrency can yield high returns, but it also comes with its own set of risks, including high volatility and potential loss of investment. So, why are these platforms important? Well, they not only present opportunities for financial growth, but they also influence the global economy, shaping business trends and consumer habits. Whether we like it or not, the stock market and cryptocurrency are becoming integral parts of our financial landscape. Knowing how these work is the first step to understanding investing. And as we delve deeper into these topics, you'll gain a clearer picture of how you can navigate these complex yet fascinating financial realms. So, what exactly is a stock? Imagine walking into your favorite pizza shop. You love their pizza so much that you decide to buy a piece of the business. Not just a slice of pizza, but a slice of the company itself. This is essentially what a stock is. When you buy a stock, you're buying a piece of a company, a share of its success, and a stake in its future. Now, these pieces or shares represent ownership in the company, making you a shareholder. As a shareholder, you have a claim on part of the company's assets and earnings. In simpler terms, when the company makes money, you make money. But how exactly does that work? Well, companies issue stocks to raise money. They use this money to grow, invest, and overall improve their business. When the company profits, these profits are sometimes distributed to shareholders in the form of dividends. Dividends are like a thank you gift for investing in the company. But remember, not all companies issue dividends. Some prefer to reinvest all their profits back into the business for further growth. Another way you can profit from stocks is through capital gains. This happens when you sell your stock for more than you paid for it. Let's go back to the pizza shop. Suppose the shop becomes wildly successful, and the value of your piece of the business goes up. If you decide to sell your piece, you'll make a profit. That's a capital gain. However, the opposite can also happen. If the pizza shop struggles, the value of your piece might go down. If you sell it then, you'll make a loss. That's a capital loss. In essence, investing in stocks is a bit like a game of prediction. You're betting on the fact that the company you invest in will do well. It's a risk, sure, but it's also an opportunity. An opportunity to not just make money but to be part of a company's journey in growth. Thus, investing in stocks means investing in a company's potential. Now that we understand stocks, let's delve into the dynamics of stock prices. The stock market is a bustling world of buying and selling where prices are constantly shifting. This movement is largely driven by the age-old principle of supply and demand. When a company's shares are in high demand, with many investors wanting to buy, the price of these shares tends to rise. Conversely, if there are more sellers than buyers, the supply surpasses the demand, and the price of the shares generally falls. But what sparks these changes in supply and demand? What makes a share suddenly desirable or conversely, causes investors to sell? There are numerous factors that influence stock prices. Company earnings are a significant one. If a company reports strong earnings or shows steady growth, this could boost investor confidence, causing an increase in demand and a subsequent rise in share prices. On the other hand, if a company's earnings fall short of expectations, this could lead to a decrease in demand and a drop in share prices. News and events also play a pivotal role in influencing stock prices. For instance, a breakthrough product announcement could send share prices soaring, while a scandal could send them plummeting. Market sentiment, the overall mood or attitude of investors towards the market, also sways stock prices. If investors feel optimistic about the economy and the market, they're likely to buy shares, pushing prices up. If they're pessimistic, they may sell shares, causing prices to fall. Finally, external factors such as political instability, changes in government policies, or fluctuations in currency rates can all impact the stock market, causing share prices to rise or fall. So, the dance of supply and demand is a complex one, influenced by a myriad of factors. It's a continuous ballet of buying and selling, of rising and falling, of optimism and pessimism. And at the heart of it all is the humble share, its price a reflection of its perceived value at any given moment. So the fluctuation in share prices is a continuous dance of supply and demand. Moving on to cryptocurrency, what is it and how does it work? Let's simplify this. Imagine money that's not printed by a government, not controlled by a central authority, and can be used worldwide with the same value. That's cryptocurrency for you. It's a digital or virtual form of currency that uses cryptography, which is a method of protecting information through codes for security. This makes it incredibly difficult to counterfeit or double spend. Cryptocurrency is often associated with the internet, and more specifically with a technology called blockchain. You might have heard of it. It's a kind of digital ledger that records all transactions made with a particular cryptocurrency. It's decentralized, meaning it's spread across many computers or nodes, which manage and record transactions. This decentralization makes the whole system much more secure because it's not controlled by any single entity and has no central point of failure. Now you may be wondering, how do I get hold of these cryptocurrencies? Well, you can buy them online using real money, or you can mine them. Mining is a process where powerful computers perform complex calculations to record transactions on the blockchain. As a reward, miners get new units of the cryptocurrency. The appeal of cryptocurrency lies in its potential to be a universal form of money that is secure, private, and operates on a level playing field. It's not bound by exchange rates, interest rates, transaction charges, or other charges of any country. Therefore, it can be used at an international level without experiencing any problems. This makes conducting transactions simpler and cheaper, especially for those living in countries with unstable currencies. Remember, with great potential comes great risk. The value of a cryptocurrency can change rapidly. While it can make you rich, it can also lead to significant losses, so tread carefully and do your research. Cryptocurrency thus represents a new frontier in digital finance. Ever heard of market trends and wondered what impact they have? Well, market trends are essentially the general direction in which the market is moving. They can be upwards, known as a bull market, or downwards, referred to as a bear market. Market trends can significantly influence both the stock market and cryptocurrency. When a trend is upwards, prices of stocks and cryptocurrencies generally increase, creating an optimal time for investors to buy. Conversely, when the trend is downwards, prices tend to decrease, which could be a signal for investors to sell their assets. Investors use these trends as a guide to help them make informed decisions about when to buy or sell. By understanding and analyzing trends, they can predict potential changes in the market and adjust their investment strategies accordingly. In essence, trends can be a powerful tool for investors. They provide valuable insights into the market's potential direction, helping investors make smart, strategic decisions. So, are the stock market and cryptocurrency as complex as they seem? Not at all. Today, we've unpacked these seemingly complex concepts into manageable, bite-sized pieces. We've explored the dynamic world of stocks, delving into the rise and fall of shares and the impact of market trends. We've learned that the stock market is a bustling marketplace of opportunities where businesses and investors meet, exchange, and grow. Then, we ventured into the digital frontier of cryptocurrency. We've demystified this revolutionary financial system and discovered its potential to reshape the global economy. In truth, the complexity of these subjects lies not in their nature but in our understanding. Once we grasp the basics, we stand on the threshold of a world full of economic potential and opportunities. Thank you for watching, and remember, understanding investing starts with understanding these basics.